So nice to have you with us this morning. Some cautious trading action in the air as we make our way to the opening bells. As we mentioned, they're getting back to business on Wall Street after the Juneteenth holiday. Now, we saw a softer day in Toronto trading on Monday, but the index has bounced off its May lows. Meanwhile, we've talked an awful lot about the S&P 500's bull market run. Of course, a lot of that is due to tech's muscle this year, but we've got a unique battle that is brewing between the bulls and the bears. On the one hand, you have one of the most bearish voices in Mike Wilson from Morgan Stanley, once again warning investors that the strength in stocks cannot last. He points to lingering growth concerns. But then you've got some analysis from Citigroup this morning saying that positioning in U.S. stock futures is signaling the most bullish since 2010. And easing inflation pressures are starting to temper some of the growth concerns. In fact, Bloomberg Intelligence notes that analyst estimates for the S&P 500 operating margins are back to their peak from 2022 after declining for more than a year. For more on the bull-bear debate, let's kick off our coverage this hour with Ed Clissold, he's chief U.S. strategist with Ned Davis Research. Ed, nice to see you. Would you find yourself more in the bullish or the bearish camp right now?
We're siding with the bulls at this point, and there's a couple reasons for that. One is that we do see some economic concerns on the horizon, but those are not immediate, and the market can rally for a while longer before those, if they do come to fruition, before those start to show themselves. And then secondly, from an investor sentiment standpoint, there's been so much concern over inflation, over the Fed, over the economy, that a lot of people have been positioned bearishly. So any sort of good news is bringing people into the market. I think that fear of missing out, or FOMO trade, is behind the recent surge in the S&P 500.
And so I guess the idea of a sustainable bull market run, which we've talked with you in the past about, at what point we should feel confident in describing something as a bull market, because off the top I mentioned the TSX has not rallied as much as the S&P, and those who are a bit more cautious on the momentum constantly point to the outsized influence for technology.
Well, that narrow market is not sustainable. So this can happen one of two ways. Either those handful of stocks come under pressure and then you go back into a bear market, or the market can broaden out from here. A lot of times what happens is people think about the worst case scenarios, like the dot-com bubble in the early 2000s and the Nifty 50 area in the early 70s, where it was very narrow, and then you had massive bear markets. But there's been other cases, like in the fall of 2020 and in early 1980, where you had a narrow market, but then it broadened from there. And what we've seen over the past few weeks, John, is actually a nice broadening. Over 60% of stocks in the U.S. are trading above their 200-day moving averages. And technical analysts use that as a nice long-term gauge. And if this was a really narrow market, we would not have that many stocks above their 200-day. So the broadening is happening. We need to see some more of it. But we've made some progress over the last few weeks.
I guess, when we talk about valuations as well, the question that you have to consider is not just price action, but the bottom line performance. And I made that reference to Bloomberg stats on expectations for operating margins. Maybe that's the one thing that we didn't consider. I mean, not that every action by a company is all that encouraging when they're cutting costs or watching their costs, but the ability to show some strength on that front maybe was underestimated by some.
We certainly saw that in the first quarter earnings season. The beat rate, or percentage of companies that beat expectations, jumped from the upper 60s up into the upper 70s, about 79%. That broke a 2-year downtrend. And so I think what you saw is companies get a better handle on the environment, and just the fact that inflation came down certainly helped them get a better handle on things. And so with valuations being high, one of the ways you can deal with that is to grow out of it and to get better earnings. I'm a little concerned later on in the year because expectations in the second half are a lot higher than the first half. So we may not be able to play that nice beat game like we did in Q1. But the idea of earnings collapsing, which was some of the bear case, doesn't seem to be coming to fruition at this point.
So I guess what are the biggest things that you'll be watching from this point onwards?
Yeah, so two things. One is when we talk about valuations, valuations relative to bonds have gotten less attractive for stocks. If you can get well over 5% in Treasury bills, that raises the hurdle for what you would need for a required return for stocks. And so that is something we have not dealt with since before the financial crisis. And then the other thing is that as the market rallies, you're going to pull more people off the sideline. Our sentiment indicators have gone from showing deep, deep pessimism to now they're kind of neutral. If we get some pervasive optimism, that is, everybody has already gotten off the sidelines, then we have the reverse of earlier this year, where any sort of bad news is going to bring some sellers because everybody has bought. So relative valuations, and then we're going to look at investor sentiment as well.
Hey, great to have